Hello everyone, and welcome to today's CMC Markets Education webinar as part of our Trader Development Series. My name is Michael McCarthy and I'm the Chief Market Strategist with CMC Markets in Sydney, and today I'll be looking at a correct use of Bollinger Bands. Before we begin though, there's some important information for you to consider. First of all, this presentation is general in nature. It does not take into account your personal circumstances, and the ultimate decision as to whether or not all or any of the information in today's presentation is useful to you in your trading and investing activities is up to you. Secondly, today we'll be talking about trading, and particularly trading with CFDs. CFDs employ leverage, and leverage has the potential to magnify both potential profits and potential losses. And it's very important that anybody who is thinking of trading CFDs understand this risk aspect of CFDs before trading. There's more information about CFDs and the risks involved in our product disclosure statement. You can find more information on our website. And if you still have further questions, please call our team on the number you can see on the screen in front of you. But if you still don't have enough information to decide whether or not trading in CFDs is right for you, please seek independent advice. So today we'll be looking at Bollinger Bands. We'll ask, what are they? We'll touch on a much neglected use of Bollinger Bands, and that is as a guide to current volatility. And then we'll look at Bollinger Bands in a trading context. We'll look at one correct use of Bollinger Bands, according to the theory anyway. Now, Bollinger Bands were first developed by John Bollinger, hence the name, in the 1980s. And essentially, they're a graphical representation, a chart-based guide to the extremes of price movement. And the underlying principle of Bollinger Bands is when daily price changes are a long way from the average, they're more likely to return to the average price. Now, note that I said more likely. I don't know of any technical indicators that are 100% correct all the time. What we're looking for is a higher likelihood of a profitable change in price. And using Bollinger Bands in a correct way can increase a trader's chances to find higher probability trades. So here's a picture that many of you will have seen before. This is a chart of the Australia 200 index, and it's a candle chart. Now I've just changed all the candles to the same colour for the sake of illustrating Bollinger Bands. And the Bollinger Bands themselves are these pink lines above and below the price. And you can possibly see what I mean by saying that they represent the extremes. The price rarely moves significantly away through the Bollinger Bands on either side. And that's because of the way they are calculated. Now this center line, the purple line on your screen, is just a simple moving average. And while some traders prefer to use an exponential moving average in here, for mine, the simple moving average is sufficient. Bollinger Bands are calculated mathematically. Now don't be concerned, you won't be asked to do any calculations. In fact, the computer will do it all for you almost instantaneously, and there will be no exam at the end of this presentation. But for the purpose of understanding what Bollinger Bands do, we'll have a quick look at the principles behind their calculation. Essentially, the computer takes all the price moves for a period. On a daily chart, we normally look at a 20-day period. It then graphs those price changes depending on how frequently they occur. And the most frequently occurring price change is the average or the mean, and the mean sits in the middle of this curve. So on this vertical axis, we're looking at the frequency of how often a particular change occurs, and along here we see how much the actual price change deviates from the average. And these measures here are standard deviations, another statistical term that mathematicians like to throw around. Once again, we don't need to know how standard deviations are calculated to get the principle underlying Bollinger Bands. Essentially, price moves close to the average price move are most common. As we see price moves that are strongly more positive than the average price move, they become less and less common. And same with strongly negative price moves. As we move away from the average, as the daily change is much more negative than the average, we see that those changes occur less and less often. And what this graph is showing us is that most of the time the daily price change is around average, and occasionally we get extreme moves either up or down that occur much less frequently. And the principle of Bollinger Bands is when we get one of these, when we're out in these extreme areas of the price change distribution curve, we're likely to get a move back towards the average price. You may have noticed when you call up Bollinger Bands on the platform that the standard default setting is 20 days and 2 standard deviations. Why do we choose these? Well, the 20 days is simply roughly the number of trading days in a month. We try and keep the terms for Bollinger Bands fairly tight, because if we put in a large number, and you can try it yourself by, say, setting the day setting to 180, we'll find that the actual price can move well outside the bands and not be particularly useful in generating signals. Now, many traders change that 20 days. Some will go down to 11, some will move up to 30, others will have a favourite number, and you're encouraged to try changing the number of days in the settings to see if you get more signals or more appropriate signals in the particular instrument that you're trading or that suit your trading style. However, what I would not recommend is moving away from 2 standard deviations unless you're a very experienced trader or very strongly mathematically oriented. The reason we choose 2 standard deviations has to do with that curve we're looking at just a moment, because price changes within -2 to +2 standard deviations away from the average price cover 95% of all events in this normal distribution. So when we're out beyond 2 standard deviations, we're looking at events, theoretically at least, that only occur around 5% of the time. If we set our standard deviations to 1, you can see that we'll get a lot more signals, but the likelihood of them leading to a profitable trade is lower. Similarly, if we go beyond 3 standard deviations, the curve here is so small that we're not very likely to get many price signals or many trade signals. And that's why I'd suggest keeping the standard deviation setting at 2 all the time. One of the neglected uses of Bollinger Bands is that they are a very good, quick and ready guide to volatility. As price volatility increases, the size of a deviation also increases. And so because our Bollinger Bands are showing us 2 standard deviations from the current price, from the average, they will start to widen as volatility increases. And we can see this in these periods here. We've seen a strong move persisting, the moves are getting bigger, volatility is increasing, and the Bollinger Bands are widening here and here. On the other hand, where a price is trading fairly regularly with smaller trading ranges and smaller close-to-close changes, we're in a period of lower volatility and the Bollinger Bands will move together. Now, volatility often gets negative headlines, particularly from an investment point of view. Investors don't like volatility, but volatility can be the trader's friend. I say can because in higher volatile times, more volatile times, we get larger price moves leading to potentially greater profits. Those larger price moves also mean that we're at greater risk. And trading discipline is always important in the market, but it's very important at times of high volatility. And Bollinger Bands can alert traders to times when volatility is increasing because the bands will be widening, or when volatility is dropping away because the bands will be narrowing. Now you can inspect that visually on the chart. You can see here when they're narrowing or widening, but we also have another indicator known as Bollinger Band width. So you don't have to run your ruler over the screen. You can simply add the Bollinger Band width indicator to the bottom of your screen and it will graph for you the changes between the high and the low band. And that measurement is in the points of that instrument. So in this case, you can see that the distance between the high and the low Bollinger Band has recently dropped away from 200 points for the Australian 200 index to somewhere around 150 points. But it's the slope of this curve that's important. This is showing us widening, this is showing us narrowing. This is showing us increasing volatility, this is showing decreasing volatility. A very useful and quick guide to current market conditions for many traders. Now, I mentioned before that mathematicians had normalized the distribution. They do that for a good reason. It makes it much simpler to make the calculations that led to the breakthrough that was Bollinger Bands. But the real world is different. This blue line is the normal distribution, a friend of the mathematicians. But the experience of real price changes in stocks, in currencies, in indices is actually more like this red curve. You'll note that average moves occur less frequently than in the normal distribution, and that extreme moves are actually more common in the real world than the theory suggests. And that has important implications for the way traders apply Bollinger Bands. Now, I've mentioned before that Bollinger Bands, in my experience, both as a trader and as a manager of traders, are amongst the most misunderstood and therefore misused indicators. So let's move towards a correct use of Bollinger Bands. Now, remembering that the underlying principle is that the price moves outside the Bollinger Bands are extreme events or less common events, and that the signal that we're looking for is that we'll see a move back towards the average price. So the signal doesn't occur when a price hits the Bollinger Band. The signal actually occurs after the price has moved outside the Bollinger Bands and then starts to head back towards that average, what traders call reversion, or reversion towards the mean. So the signal doesn't occur when the price goes outside. The signal occurs when the price re-enters the Bollinger Band area. Now, there's an important caveat, and that is when this reversion back through the Bollinger Bands occurs, the Bollinger Bands should not be widening. They should be steady or narrowing. And the reason for that is to do with the fat tails we were talking about earlier. When markets are increasing in volatility, extreme moves are more likely. And of course, as we've just seen, when the Bollinger Bands are widening, volatility is increasing. So a reversion back through the Bollinger Bands that are widening is not as reliable a signal as when the bands are steady or narrowing, because they're telling us volatility is still increasing and extreme moves are more likely. And for those of you who are so oriented, this concurs with a theory observed by options traders known as volatility clustering. That is, when we get a high period of volatility, it's likely to persist for a little while before reverting back to more normal levels. And so this is a key filter on using Bollinger Bands correctly, that when we get the reversion signal, the price has moved outside, has now moved back in, we're looking for a move back towards the average, the Bollinger Band should not be widening, they should be steady or narrowing. Now, it's important to reiterate that we once again are in the real world as traders. There are no guarantees and signals can fail. But the beauty of the Bollinger Band signal is that it has a very clearly defined take profit, a move back to the average, but also allows traders the opportunity to set a tight stop loss, because no signal will give us 100% accuracy in predicting market moves. We must always be prepared to step back and say, this trade is not going right, it's time to cut out. And the first cut is always the cheapest. So setting a stop loss just above is if the price has moved up through the Bollinger Band and then reverted back through, setting a stop loss for that trade just outside the Bollinger Bands can mean that we can limit the risk on trades very easily and with mathematical precision. So let's have a look at a few live examples of Bollinger Bands. Now, I have a couple of charts here that I noticed have got some good signals for us. This is the silver chart, the cash contract, and I'm just going to add the Bollinger Bands as you would do if you were looking at the platform yourself. So I've clicked on technicals. We'll now stay with overlays and choose Bollinger Bands. You see those default settings that we were talking about earlier, a 20-day period and 2 standard deviations. And I'm going to stick with the standard setting because for me that works, and I think we'll find on silver it can give us some reliable signals. So let's add those Bollinger Bands. And as you can see, we've got periods increasing and decreasing volatility. I'm just going to change those colors to make it clearer what's what. I'm going to make the Bollinger Bands bright green and the moving average a dark green. And now you can see quite clearly the bounds of the price action. Now let's add in the Bollinger Band width so we can make an assessment of how good any of these reversions back through the Bollinger Bands were. And once again we go to technicals, but this time we'll select studies because this will appear below the chart. And you'll see that just along the bottom here we have a Bollinger Band width. It's important that the period that we choose for the Bollinger Band width should be the same as the period that we chose for the Bollinger Bands themselves for consistency's sake. And once again, I'm just going to sharpen up the colors here so that it's more obvious what we're looking at. And as you can see, the Bollinger Band width here in silver has fluctuated enormously from below $1 per ounce to above $3 per ounce. And that's reflected in the moves that we're seeing on this chart. And to illustrate that principle that we talked about before, here's a good example. The price has moved outside the upper Bollinger Band and has then reverted through. That's the time to check to see if we've got a valid signal. And of course the check is, are the bands widening? And if we use one of the drawing tools to line these up, this is the vertical line, when it reverted through, we can see down here that the volatility, the bands were still widening, volatility was increasing, and therefore this would not be considered a very useful signal. It is still possible, of course, that the price might return to the average, but what we've seen here is that the average actually returned to the price, and that's what the widening bands were warning us against, that this was a less reliable Bollinger Band signal. But let's have a look at a good example. Here's one that occurred within 1 day. You can see that on this day, silver dropped through the bottom of the Bollinger Band and then almost immediately reverted back up through it. It's that move back up through the Bollinger Band that gives us our buy signal, looking for a turn to this average. And in this case, we can see down here that the bands were not widening. Well, if they were only widening very, very slightly. I would call that steady. And that turned out to be a much more reliable signal, albeit it did take 3 days to get to that point. Here's another example where we saw a 1-day spike outside and reversion straight back through. The bands were not widening, as we can see down here, and the next day silver returned to the average. So once again, it's important to remember that the bands, then their widening or narrowing, is one of the keys to a correct use of Bollinger Bands. Another example of one that didn't work. Went outside, came back inside the bottom band, but the bands were widening. And in fact, buying at this point could have been a problem. So we sell when we revert back through the top. We buy when we revert back through the bottom, as long as the bands are not widening. Here's an example of a trade that I would not have taken. The silver dropped through the bottom band, reverted back through, but the bands were widening. Now, fairly soon afterwards, volatility calmed down, and we did actually get a reversion back to the average price. But it's not a trade I would have taken, because I'd suggest that because those bands were widening, this was a lower probability trade. And what I'm looking for by applying these filters to the way I use Bollinger Bands is higher probability trades. Let's have a look at another example, and in fact, this one is of particular interest and shows how Bollinger Bands can help traders decide when a market is possibly changing trend, possibly continuing a trend. The Australian dollar has fallen significantly over this period from mid-October to December. It then had a period, about a month, of sideways trading. It tried to move up, and in response to some fairly weak job numbers around here, has fallen to the 4-year lows. The question is this going to break through and continue its downtrend, or does it bounce off this point? Well, Bollinger Bands can help us make up our minds around this. So let's add them to the chart. We will go to the technicals, select overlays and Bollinger Bands. We'll keep 20 periods and 2 standard deviations. And here are our Bollinger Bands with the moving average in the middle. Let's also add in our Bollinger Band width. And we can see here that there was a modest uptick in the volatility here, so we may not have taken this signal, even though in this case it turned out to be a good signal. Looking at this and pulling up the draw tool for a specific comparison, on the day it reverted back through, you might have taken that trade. That is fairly flattish in that period. I might have taken that trade as a sell as it reverted back through, looking for a move back to this average. And in fact, that would have been a pickup of a little over 100 points. You can see, however, that we are looking at this period here and trying to work out whether we've got a break. And it's fascinating to see that this Bollinger Band also coincides with the support level. Now, it's clear that volatility is starting to increase, and it doesn't matter whether volatility is up here or down here. It's the change in volatility that's important in deciding whether or not we've got a signal. And because that is increasing, I'd suggest this is not necessarily a reliable signal, or it's not a signal that would fit my trading plan anyway. So it's not a trade I would take, and that leads me to think, particularly with this pickup in volatility from very low levels, that we could actually see a continuation of this trend. Even if it keeps me out of a small losing trade, this is a useful tool to me. By the way, it's interesting to note that we do have, as we've flagged before, a signal here that I wouldn't have taken that turns out to be a profitable one. And in this case, you may or may not have taken it and it would have been a profitable trade. Let's have a look for an example of, here's a very good example where the volatility had been decreasing. We didn't see the reversion back through the band here. By the time it does revert back through, volatility is clearly increasing, as evidenced by this pickup in the width of the bands. And this trade did not work out well. And that's the importance of that filter. So there's been a lot for you to think about today. As I say, because of the abuse of Bollinger Bands, I felt it important to talk about what Bollinger Bands are and how they can be used more correctly in the market. It's important too to remember that they can be used also as a quick eyeballing of a chart to decide whether a market is getting more or less volatile, depending on what suits your trading plan. Thanks for your attention today. Please go to our blog at blog.cmcmarkets.com.au, because over the next few weeks we'll be putting up real-time examples of Bollinger Band signals that fit the criteria we've just outlined. That is a re-piercing of the Bollinger Band without a widening of those bands, and tracking those trades to see how reliable the signal is in real markets.